Welcome to episode 5 of Stock, Paper, Scissors. I'm Ben, and as always, I'm here with Alex. Alex, I have to admit, after our last talk about market gravity and yields, I spent my weekend staring at maps. Not stock charts, actual maps of the world. Because right now, there is a tiny 21-mile wide strip of water that has more power over your portfolio than almost any CEO on Wall Street.
Let me guess. You've been obsessing over the Strait of Hormuz again. I saw you printing out a satellite view of the Persian Gulf earlier. You looked like you were planning a heist or something.
It's not a heist. It's the ultimate chokehold. Think about it. If you're driving right now, imagine if 20% of every gas station in the world suddenly had their supply lines cut by a single locked gate. That's the Strait of Hormuz. It is the jugular vein of the global energy market, and when things get tense there, the whole market gets a fever.
It's a great analogy, Ben, but let's slow down for a second for everyone listening. Before we get into the why of the stock movements, we have to look at the where. The strait is that tiny passage between Oman and Iran. At its narrowest, the shipping lanes, where these massive tankers actually move, are only about 2 miles wide in each direction. It's a needle threader for the world's oil.
Exactly. 2 miles. That is essentially a driveway for a ship the size of the Empire State Building. And through that driveway, we're talking about roughly 21 million barrels of oil every single day. That is our first big stat for the day. Nearly 1/5 of global petroleum consumption passes through that one tiny gap. If that gap closes or even just gets uncomfortable, the math changes instantly.
Right, and that's where the crude awakening happens for traders. When a headline drops about a tanker being seized or a military drill in the strait, you see oil prices, specifically Brent crude, spike almost instantly. But, and this is the important part, it's not just about the oil, it's about the risk premium.
The risk premium. I love that term because it sounds so fancy, but it's basically just a fear tax. It's the extra amount traders are willing to pay today because they're terrified there won't be any supply tomorrow. It's like if you heard there was a bread shortage coming. You might pay $10 for a loaf today just so you don't go hungry on Tuesday, even if the bread is still sitting right there on the shelf.
Exactly. But here's where it gets tricky for people trading energy stocks, the XLEs or the Chevrons of the world. A lot of beginners think, oh, oil is going up because of a war threat. I should buy oil stocks. But it's not that simple, is it? Hold on. I'm pulling up a chart from 2019 on my phone. Remember the tanker attacks in the Gulf of Oman?
Oh, I remember. I was actually in a trade on an oil service company back then. My heart was in my throat. I thought it was going to be a genius because crude was jumping 4% in a morning. But then I looked at my stock and it was barely moving. It was actually down a bit by midday. I was so confused. I felt like I'd predicted the weather correctly, but still got wet.
And that is the trap. Why didn't your stock follow the oil? Well, it's because the market is smart. If the oil price is high because of scarcity or conflict, it's not the same as oil being high because the world economy is booming and everyone is buying more gas. Conflict-driven price hikes are actually a drag on the global economy. They're like a giant tax on every consumer, which eventually lowers demand for, well, everything.
Right. It's the difference between a high price because everyone wants your product and a high price because your factory is on fire. One is great for business. The other is a disaster. It reminds me of the tanker war in the 1980s. That's our second historical touchstone. Between 1980 and 1988, during the Iran-Iraq War, they weren't just fighting on land. They were targeting each other's tankers in the strait.
Wait, remind me of the numbers on that. Wasn't it hundreds of ships?
It was insane. Over 540 ships were attacked or damaged. The U.S. Navy eventually had to step in just to escort commercial tankers. And yet, if you look at the stock market during some of those peak tension years, it wasn't a straight line up for energy companies. There was so much uncertainty that the volatility actually scared away the long-term smart money.
That's such a key point. High volatility usually means lower liquidity because the big institutional players don't want to get caught in a gap where the price jumps from 80 to 90 overnight while the market is closed. It makes the market feel like a casino instead of an investment environment. If you're a retail trader trying to play a Hormuz headline, you're often playing against algorithms that can read that news and execute a trade in milliseconds.
Total Matrix vibes. You're trying to click buy while the computers have already priced in the news, moved the needle, and are already looking for the exit. I remember one time I tried to revenge trade a news spike in the Strait. I saw a headline about a drone, I hit buy, and by the time my order filled, the price was already retreating. I bought the literal top of the fear.
We've all been there, Ben. Don't be so hard on yourself. But that leads us to a really important distinction for our listeners: the difference between crude oil futures and energy equities. When the Strait of Hormuz gets mentioned, the futures market, which is where people trade the actual price of oil for future delivery, goes wild. But the stocks, they have to deal with the reality of insurance costs, shipping delays, and the fact that if a war actually breaks out, their infrastructure might be at risk.
It's like owning a fleet of taxis. If gas prices go up, you might think, hey, my product is more valuable. But if the reason gas is expensive is because there's a riot in the middle of your city, your taxis can't actually go anywhere. You're paying more for fuel and doing fewer rides. It's a double whammy of bad news.
Perfectly said. And let's not forget the broader market. When oil prices stay high because of the Hormuz chokehold, it acts like an anchor on the S&P 500. It drives up inflation, which makes the Fed want to keep interest rates high, bringing us right back to the yields we talked about last week. It's all connected.
Oh man, the Yield-Oil-Hormuz triangle. That sounds like a Bermuda Triangle for portfolios. So if someone is looking at these headlines and feeling that itch to trade, what's the move? Do we just sit on our hands?
Well, usually yes. Or at least you look for the divergence. If the news is terrifying but the stocks aren't moving, the market might be telling you the threat is overblown. But if the stocks start dropping before the oil price spikes, that's a sign of real systemic fear. That's when you really have to be careful.
That brings me to our golden rule for today. I've been thinking about how to phrase this. Let's go with this. Supply shocks are temporary spikes. Demand shifts are long-term trends. If you're trading a headline about a closed strait, you're trading a spike. Spikes are sharp, they're painful, and they usually come back down just as fast as they went up.
I like that. It's a reminder that geopolitical tension is often a lease on high prices, not a permanent ownership. Once the tension eases, even a little, that risk premium evaporates like water on a hot desert road. If you bought at the top of the fear, you're left holding a very expensive bag.
It's the bag of fear, not a great accessory for any wardrobe. I guess the takeaway here is that while the Strait of Hormuz is a massive strategic point, it's often a noise generator for short-term traders. It creates a lot of heat, but not always a lot of light for your long-term strategy.
Exactly. Look at the data, not just the drama. If you see the VIX, the fear gauge, spiking alongside oil, you know it's a sentiment-driven move. And as we always say, sentiment can change faster than a tanker can turn around in a narrow strait.
And those tankers take miles to turn around. This has been a heavy one, Alex. Geography, history, and the terrifying reality of global supply chains. I think I need to go look at a chart of something boring, like, I don't know, a company that makes staplers.
No such thing as a boring chart if there's money on the line, Ben. But yeah, let's take a breath. Just remember, everyone, we're here to learn and explore. Nothing we say is financial advice. We're just two friends trying to make sense of why the world moves the way it does.
Well said. I'll stop printing out satellite maps now. Maybe. No promises. Anyway, keep an eye on those narrow passages, keep your risk managed, and we'll see you all in the next one.
Stay safe out there and keep watching the horizons. See you next time on Stock, Paper, Scissors.